somewhere about 7.4 to 7.5 million ton in the year ending by March 2021, and we'll reach to those figures of 7.5 million ton. This is what we are expecting. The market is excellently well. Market is good. The demand pullers are European countries as well as Southeast Asian countries. We are exporting a substantial quantity now once again in the export market. The hot rolled coil prices worldwide has recorded our highest benchmark. Today in Europe, because of the second wave of COVID, the demand has increased. The countries like Italy, like France, Denmark, Australia, Germany and France, and also Spain, and they are buying in bulk, and the demand is pretty high. The selling price in these countries today is about $816 to $820 a ton, which is much higher than the domestic price in India. Similarly, the Chinese government, they are not exporting much to the international level, so which has created a huge gap from the countries, those who are dependent on China. So now they are banking upon the countries like India, Iran, Russia and Ukraine. Since Iran is under sanctions by UN, so not many countries are buying from Iran. So their preference goes to India because Russians and Ukrainian mills are also facing a threat of COVID-2 wave, as well as the extreme bad weather conditions are forcing them not to supply too much of quantities to the world market. So India has become a hotspot in terms of sourcing the steel, and the Indian steel industry is getting dividend of that. We are in a product of very high value-added engineering products, whereas we have created a very fine balance in between value addition and value engineering. And this is the reason we are getting a sizable quantity of orders at a very good price from Europe. Of course, the steel as a whole, the steel market in India has also grown up. The steel prices have gone up because of the pent-up demand which has come. And as we said by Madam Mrs. Nirmala Sitharaman about a month back, that the pent-up demand has come up, and today Indian projects are consuming many steel as well as cement, so that they can meet out their targets. Because most of the projects which were halfway during the COVID time, they want to complete during this stipulated period so that they can reduce their losses or they can make some profit. So this is the reason the demand has come up in a big way. Thanks to Government of India and our Honorable Prime Minister for declaring the Atmanirbhar Bharat policy. This policy has given a straight impact to the Indian steel industry, and we are now in a position to supply steel to various projects which are coming forward. So the issue is now, of course, the iron ore prices have also gone up in last quarter, and NMDC has increased the prices, OMC has increased the prices, and finally the iron ore prices have gone up. But this is an international phenomena. It is not a domestic phenomena. The international steel prices have gone up. International iron prices have gone up from $140 to $165. It touched also $170. Now in last 10 days time, we are seeing some softening, but that was $3.5 per ton in last week, and this week is about $1.25. Total is about $4.75. So still the iron ore is at about $165 to $167 per ton. These are the fines of 60 or 61 grades. Now coming back on the coking coal, we as a steel industry, we enjoyed the last quarter because the coking coal prices were low. So we have booked coking coal till April or May of 2021. So our supply chain is very well in line with our policies. And now the coking coal prices started moving up. So we are now started thinking as to how to start our coking coal mines in Australia as fast as possible, and how to ramp up the production in Mozambique. So today coking coal prices are $130 FOB. It used to be about $99 or $100 FOB about a month back. So the increase is about $30 or $31 per ton, which is giving us an attraction to restart our mines, and those mines in Australia. So hopefully will be our first vessel carrying the coking coal will be touching Paradip port in the early June 2021. We have the stocks available today up to May, and we'll be maintaining a good flow of coking coal from our own mines in Mozambique as well as in Australia, and also we have anthracite mines in South Africa. All these three mines will be feeding coking coal and distillized products to us. Hopefully we'll be self-reliant from June onwards. Maybe we'll be buying a little quantity, because at the moment we are buying about 6 to 6.5 million ton. Maybe we'll buy from outside, maybe about 2.5 million ton, and balance 4 million ton will be from the local sources, from our own sources. So it'll be we are on a path of getting self-reliant. As far as the iron ore is concerned, since we are lucky that we are sitting in the iron ore hub of India, where the maximum iron ore is existing and mining is being done. More than 120 million ton of mining is done over there. So we are in Odisha. So we have three phases of working. One, we are own mines, that is Tensa mines, where we produce about 3.1 to 3.2 million ton as per EC norms available. The another is we have some stocks lying in our SMPL premises, that is this SMPL premises we have now about 4.5 million ton, and this 4.5 million ton of the total quantity which is available today, this will be consumed over the next 2 quarters. So we are comfortable for the next 2 quarters. Then another good factor is that we have long-term agreement with OMC, that is Odisha Mining Corporation, and they are supplying regularly to us. There is no problem, no dearth of iron ore. Of course, the prices are up, but so are the prices of the steel. So we have also signed an agreement with NMDC so that our Chhattisgarh plant can be fed substantially from NMDC side, from Bacheli and Jagdalpur, and that is also feeding us in a good way. We have also made some arrangement in Jabalpur in the central India, where the iron ore beneficiation plants are already existing, and we are meeting out our demand. So in a nutshell, we are not looking any shortage of iron ore in the next 2.5 years time. In the meantime, we are also scouting for the iron ore mines. If we can get at the right price, then definitely we'll do it. SMPL, we have a long-term agreement with them, as we are one of the 21 customers of theirs. So they are feeding us, they are meeting out their commitment to us. There is no problem at all. So as far as the raw material side is concerned, basic two major raw materials, one is coking coal, the other is iron ore. We are comfortable. The other consumables, etc., like refractory and other consumables that we have lined up, we are not dependent on China now. We are buying our refractory from Austria, Spain, and Brazil. And this is where we feel that we are overall self-reliant in terms of not banking upon the Chinese supplies. So this is what the overall scenario. The numbers are in front of you, and we are expecting a very good quarter, that is quarter 4, and followed by quarter 1 and quarter 2 of the next year. So the street has shown a lot of confidence in us. From 63 rupees per share in April, you have seen that the share prices have moved to 305 rupees, barring today's stock market down because of profit booking done by people yesterday and day before yesterday, and but yes, that is normal in such kind of situations. So we feel that the company is in a very, very strong footing. As far as the human resources are concerned, fortunately, I'm glad to tell you that not even a single case of COVID today existing in any of our plants. So all of the plants are working very well. There is no issue. And we are working with the government as to how we can contribute in the growth of the country. Country is looking for 300 million ton steel by 2030. And we are intent. Yes, we can be part of country, but there are 3-4 points what we have raised to the government. Number one, there should be a structured financial institution for the steel industry and core sector industry in times to come to reach to 300 million tons by Indian steel producers. Number one. Number two, any advantage given to the fresh investors as a first-time plant or a fresh plant or a new location, like from 25% corporate tax to 15% corporate tax, we are expecting government should also give to the brownfield projects, which is very much in demand today. And the entire steel industry is looking that if the government allows for the brownfield projects, expansions also, the same shops what they are offering to the new investors, and I think this will be excellent. So today the shortfall is about 164 million tons, and if 164 million ton shortfall to be bridged, then at least we need 16 or 17 plants of 10 million ton each. And if we say 5 million ton each plant, then we need about 32 to 33 plants in this country, which is a uphill task today. If we don't do, then by 2025 we'll be importing steel worth of $50 billion. And if it is still not done, by 2030 we'll be importing steel of about $150 billion. I think no government can compromise on these things, because $150 billion of goods, if you start importing 2030, or $150 to $70 billion of goods you start importing 2025, that will totally imbalance the situation. So steel, energy, power, everything drives the economy. So lucky we are that we are in both big drivers, that is steel and power, and this is the reason we are expecting that the country will definitely grow, and company JS will grow. We are not a commodity steel player. We are producing steel for Indian Railway. We are producing steel for the Power Grid Corporation of India. We are producing steel for the shipbuilding, warship building. We are producing steel for the cryogenic plants and cryogenic storage plants. So we are a little different than our peer group, because we are not in a product which is commodity. So this is the reason the value addition from one stage to another stage that plays a very vital role. So we have devised a mechanism in our company as to how to keep a proper balance in between value engineering and value addition. And this is what we are doing. Our Honorable Chairman, Mr. Jindal, he has already told us that we have to keep on reducing our loan or debt burden, and this is the reason that from opening of more than 35,000 crores, we have come down to 25,240 crores now, and we are expecting that by year 2022, we should bring it down to 15,000 crore or below. And comparing to or seeing the conditions as of now at par in overall barometer, and our EBITDA should be more than 15,000 crore, and hopefully by 2022 we'll be doing a sales turnover about 50,000 crore. So the company slogan now is 15, 15, 50. And this is what we are aiming. And if we do this with the help of all of our investors and supports from the Government of India, with the Atmanirbhar approach what Government of India has taken, and the kind of support that Government of India is giving for the new projects, I think we will be amongst the top 7 companies, private sector companies in the country, keeping away the public sector group, but the domestic private companies will be in the top 7 companies. Today, I'm also pleased to inform you that worldwide our rating has improved. We are 15th company in the world today as a steel producer in terms of effectivity, efficiency, and cost of production. And hopefully we will be coming to in 2 digits or single digit immediately, maybe in 10 or number 9 in the world. So today, if you see, JSW is at 9 and Tata Steel is at 10. So I think our rating will come maybe at 8, 9 or 10 number in next 1 year time. So this is what we are aiming and contemplating that as to how to reach to those levels. Finally, if we see overall power business also done extremely well, and you are seeing that the power PLF has come to about 56 to 58%. And finally, we are getting our coal mines, that is JPL. The JPL mines is likely to start somewhere about 6 months down the line, or maybe 8 months down the line. So this is all from my side. Now I'll request my colleague, Mr. A.R. Sinha, who is chairman of JPL and also director of finance JSPL, to give elaboration on JPL. Thank you.
Hi, can everybody hear us? I thought there was some pause in the line. We couldn't hear. Mr. Sinha, please.
Sir, the audio is clear.
Good afternoon, gentlemen. Good afternoon, gentlemen out there. Let me start with wishing you a great 2021 and hope that all well at your end. Like Sharma or MD said, that we have there's a situation here where we do not have a good situation, where we do not have any COVID case in our company, anywhere in the plant, head office, anywhere. I hope you people are also safe. I don't feel very happy to say that the challenges which we had in the last 2-3 quarters, power sector in India, we continue to see the same challenges. And in fact, the challenges are becoming more and more acute, in my opinion, when we go forward. The challenges with regard to the exchange price on the spot exchange market, the challenges related to the availability of the midterm and the long-term PPAs, the challenges of DISCOM dues, and just to elaborate on that, the power demand remained quite modest. In 2021, the demand in the country, as of November, I'm giving you this figure, is just 314 billion units, just 6 to 7% more than the last year. So there is hardly any impressive increase in the demand. And if we look at the prices which were there on the spot market in the last 3 quarters, there has not been much increase. In the first quarter, the average rate was about 2.40 kilo per watt, and in Q3 it is 2.52 per kilowatt. So average for 9 months, it's hovering around 2.47 per kilowatt. The PPA status remains a challenge because no new PPA has been signed, neither in the midterm nor the long term. DISCOMs are not in a position to sign the long-term or midterm PPAs. We are still struggling with the 420 megawatt PPA which we won, quite some time back now. Though we have not given up hope, but we see this as a big challenge. DISCOM dues continues to be a challenge for us, and the figure we have as on November 20, that the dues of DISCOM against the GENCOs has gone up to and stands at about 1.2 lakh crore, which is a substantial amount, and it is impacting all the GENCOs very, very adversely. One redeeming feature was the support which came from the central government, which announced after approval of the parliament, infusion of about 90,000 crore for taking care of the DISCOM dues. Out of that, good thing which happened with JPL and with the other generators also, that from our total dues in the first tranche, we received 430 crores. Still, our deals with DISCOM and especially with Tanjatco continues to hover around 1,800-1,900 crores, which we find it as a challenge to recover, but we are hopeful that part of it should come by way of tranche 2. Now coming to some of the important figures relating to our production and our income figures. Though we generated about 120% more million units in the third quarter, and our PLF also went up from 25 to 56. But our NSR, and this is, I'm again not very happy to share this figure, NSR came down despite a higher production, despite higher exports, selling on the exchange, from 3.83 last year. The NSR per kilowatt has come down to 3.27, recording a negative growth of 15%, and this is mainly on account of a higher sale which we did just to keep our plant going on the spot exchange. And like I gave you the figure earlier, that the spot exchange rate, the rate which we get at the spot exchange is pretty competitive. On the income front, I will come straight to the EBITDA. Our EBITDA compared to last quarter recorded as just a modest growth of 18%. And we recorded a negative, our net profit is negative by 32 crores. And on quarter-on-quarter basis, again our generation went up, like I said, by 52% on quarter-on-quarter basis. PLF also went up from 37% to 56%, recording a growth of 19%. But our NSR went down compared to the last quarter, that is from 3.62 to 3.27. And this is something, this is bothering us as it is impacting the overall sustainability of the company. We made a provision of 327 crores this quarter. This was a combination of 2-3 provisions. This was continuing on our balance sheet for quite some time, and we wanted to make our balance sheet cleaner. And after discussion with the auditor, we crystallized these figures, and then it was decided, a conscious call was taken by the management to make a provision in quarter 3. We may have to make some provision in quarter 4 also, but we have not been able to crystallize those figures because we are still looking at those figures. And once the figures are, if they take some shape and get crystallized nicely, then we will be able to take a call on that. Other thing which we wanted to bring to the notice of you all was that JPL has decided to issue RPS, redeemable preference share, of 7,000 crores. This will be done in 2 tranches. In tranche 1, we will be issuing for 4,000 crores, and in tranche 2, it will be for 3,000 crores. So, overall, I'll say that while JPL standalone is doing well so far as operations are concerned, but we are constrained by these factors which are beyond our control, like realization of our dues, like less demand for power in the country. So, and coal scenario has become slightly better now, but still coal procurement is a challenge because logistics in those areas, where we have our coal plant and most of the coal plants are located, the infrastructure continues to be very poor. So logistics continues to be a problem like before. So overall, I will say that it is a modest kind of a scenario, and I'm not very optimistic and upbeat that going forward things will really improve drastically. But of course, I always keep my fingers crossed. So thank you very much for the patient hearing, and back to Nishant, please.
We would request our CFO, Mr. Hemant Kumar, for commentary on the financials.
Good day, everyone. Let me start by wishing you a very happy New Year. Hope all of you are safe and well. Although first half of this year was extremely challenging as the pandemic caused disruption of unprecedented level, demand recovery has been equally surprising, though helping JSPL and calendar year 2020 on a solid footing. But steel industry still struggles from high input prices, especially iron ore. If we see, domestic demand for most of our products has been rising month after month in the second half of the year, which is reflected in our rising share of domestic volumes and a better product mix. Continuing on our strong performance in the first half of financial year 2021, we are pleased to report our numbers for the third quarter of financial year 2021. We are happy to report that company posted a record standalone steel production of 1.93 million tons in quarter 3 financial year 21 compared to 1.84 million tons in quarter 2 financial year 21, increase of 5%, and 1.61 million tons in quarter 3 of financial year 20, increase of 20%. JSPL standalone steel sales also increased by 12% on year-on-year basis to 1.87 million tons in quarter 3 financial year 2021 compared to 1.6 million tons in quarter 3 financial year 2020. On a 9-month to 9-month period, We have seen around 14% growth in production, 5.43 million tons in financial year 2021 versus 4.76 million tons in financial year 2020. And 15% sales growth can be observed by seeing our 9 months performance. As our Angul plant's capacity ramps up, we will see volumetric expansion in our Indian sales. So the theme or the business direction is absolutely intact, I would like to assure you in this call. I further would like to move to our standalone or consolidated financials of the company. The company has reported gross total income of 12,070 crore in Q3 of financial year 21 versus 9,951 crores in Q2 financial year 21, increase of 21%. And quarter-on-quarter, rupees 8,430 crores in Q3 of financial year 20, increase of 43% on YOY basis. I am extremely happy to report EBITDA of 4,252 crores in Q3 of financial year 2021 versus 2,702 crores against 903 crores in Q2 financial year 2021, as against 257 crores of loss in Q3 financial year 20. On the full year basis, gross total income stood at 30,071 crores versus 26,633 crores, increase of 13%. EBITDA for the 9 months, 9,157 crores against 5,085 crores last year, and PAT of 6,026 crores against 656 crores in the last financial year. This relates to our consolidated financial performance. If we move to standalone financials, we have reported gross total income of 9,907 crores in Q3 of financial year 2021 versus 8,679 crores of Q2 financial year 21. Okay. And EBITDA of 8,171 crores against 4,215 crores last year. If we move to our overseas performance, I would like to mention Mozambique business sales has grown up by 16% on quarter-on-quarter basis. And similarly, if we talk about our South African mines, the sales has increased by 20% on YOY basis. I'm again pleased to inform you on Australian. There is an update in December. The development application on Russell Vale Revised Preferred Underground Expansion Project UEP has been approved by Independent Planning Commission of New South Wales IPC subject to certain conditions. I'm again pleased to inform you on a net debt basis at the end of this quarter, we are reporting a net debt figure of 25,621 crores, which reflects 3,289 crores reduction over the net debt figure reported in the last quarter of 28,910 crores. We are pleased to highlight that in the 9 months of this year, we have been able to reduce our net debt by 10,298 crores, which is in excess of the guidance which we have been sharing over the call with our investors or our financial partners. This is in line with our vision to bring the overall debt level down. Now our debt to equity gearing stands at less than 1. I just wanted to give you an interest cost also. If you see our results, interest cost also gradually coming on quarter-on-quarter basis, whether it's a standalone or is a console basis. As you know, JSPL was double rated company in the past, and that rating of the company is progressing well. I would like to assure you that we are pleased to inform you that CARE and ICRA upgraded the rating by 2 notches from BBB- to BBB+ on stable outlook. Further, company's rating has been moving to regain its rating which the company used to enjoy earlier, which will definitely result into a cost reduction in interest, at least to the extent of 30-odd%, which will result into the interest saving of around 80 to 100 crores going forward per month. And we have learned in the last couple of years, the company endeavor will remain for capex out of the internal accruals going forward. It's a pertinent to note. Now, let me shift my commentary to capex side. As we have been sharing with you every quarter, the management team has been focusing on a much disciplined response to manage fiscal environment. We have, in line with expectations, done very minimal capex. Our guidance has been in between 600 to 800 crores in the financial year 21. We are in line with that guidance going forward. We have incurred a capex of around 304 crores, which is mainly sustenance capex. With respect to, I would like to move to Oman divestment. We are very, very confident that it will happen by March 2021. It's just we are waiting for certain permissions for approvals, and I hope that it will get concluded by March 21. So with these headlines commentary, I would like to complete my initial commentary. Over to all of you for your question and answers. Thank you very much.
Operator, we would now request for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use the handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The first question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity and congratulations on excellent set of numbers. So my first question is on Jpl Structuring. I just wanted to understand the rationale of creating that structure, and specifically if the company has the option to reduce debt at Jpl itself, what is the need of giving this 5% coupon to the parent? Why not retire debt which is at say 8-9% plus? That's the first question. So if you can explain it very simplistically on what are the line items which should change on the balance sheet on back of this, and it means that there is no refinancing of debt. If you would provide clarity over here, that would be very useful. So that's the first question. Thank you.
Yeah. See, coming to the first part of your question, that why we are doing it. We have not been able to give any dividend to our shareholders for the last 4 years. Prior to that, we have been consistently giving dividends to our shareholders. So as a one-time measure, it was decided that some incentive needs to be given to our shareholders who have been very patient with us for quite some time. And so that was the main rationale for declaring their preference shares. And like I said, that it is not related to debt. This will be done in 2 parts, and as per the the standard accounting standard, the part 1 will be treated as part of the liability. I mean, but from the point of view of calculating the tangible net worth, the remaining part of 3,000 crores will be part of quasi equity. So it is not going to impact any of the important parameters on the balance sheet. We will continue to be in compliance with all our covenants so far our debts are concerned. And the operation will continue as it is. Now, coming to the second part of your question about the divestment thing, I'm not in a position right now to tell you that divestment will take place, but definitely we are exploring all the options available on the table. And then for a right price, we will take our call when to divest and how to divest. I mean, everything worldwide is up for sale for a right price. So we'll also wait for right price. As of now, we are not running a process, but we are open to it.
Okay.
And other thing is that, and like I said in my commentary, that the thermal energy outlook for the country, in fact, worldwide, I will say, why about our country? So worldwide also, the thermal energy prospect is not very bright. And we have also taken a conscious decision to focus more on our steel business. So this will also give a stream of income to our parent company JSPL coming out of this RPS. So in the entire scheme of things, this fits in very well. The focus will gradually shift from thermal to steel, and we want to remain focused on developing our steel business while continuing with the JPL also, but about which we are not very optimistic about the future. Thank you.
Okay, thanks. My second question is for Sharma ji. Sir, what we figured out is we had groundbreaking of a new pellet plant in Odisha. Just wanted to understand how much is the capex over here. We haven't spoken about it. Does it mean that we are also looking for a slurry line and probably another phase of expansion of 3.5 million ton if one looks at mass balance? That's the second question. And if it is long term, say over 3 years, if you can quantify some numbers and timeline, that would be great. And just a follow up to the prior answer, my sense would be that it would definitely impact certain covenants given we are moving from general reserves to another line item. So why is it that it should not impact the covenants? Thank you so much.
Good, Ritesh. Thank you so much. So first of all, your question regarding pellet plant groundbreaking ceremony or pellet plant project. You see, we have a continuous desire and continuous efforts to reduce our cost of production. Because at a point, sometimes it comes that the cost of production or cost of operations cannot be reduced. So for that, you have to go for a different strategy. So strategy today is why to utilize the high Fe contents of iron ore, why not to enrich the low-grade iron ore and convert into a pellets. So this is what is tempting us to bring this particular investment as a pellet plant. And of course, this will be fed through a slurry pipeline. Today, our cost of transporting pellets or iron ore is around 1,200 rupees to 1,500 rupees per ton. We want to bring it down to 150 rupees per ton. So the net impact will be, the gain will be about 1,200 or 1,300 rupees a ton. This is where we want to encash the situation. Because we have already reached to a saturation point that if we do not do such kind of arrangements of logistics, we cannot reduce the cost further. So this will definitely increase our bottom line. This will increase our profitability, and this will give a very healthy sign to the company. So this is the reason that the pipeline and the pellet plants are offering, and this is what we are going to do. Hope I have answered your question.
Yes, sir. And on the covenant? Thank you.
Sorry, could you repeat your question, Ritesh, please?
Nishan, my question is specifically on the covenants. I think Mr. Kumar made a comment that the covenants won't get impacted. Pardon me for my ignorance, but if we are moving to something from general reserves and we are creating two separate line items over here on a quasi-equity and probably a liability, shouldn't it impact the covenants or the gearing ratios? I'm assuming this is not any fresh debt. It is just reclassification on the balance sheet.
No, there's no fresh debt which we are going to incur. That is for sure. And other part I have already answered that it is going to be in two tranches, and as per the Indian accounting standard, how the balance sheet treatment will be given. This I've already clarified in my earlier reply. So I have nothing more to add here. Thank you very much. If you need any further clarification, please contact our investor relations head, Mr. Nishan.
Sure. Thank you.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good afternoon and thanks for the opportunity. First question is continuing on the previous question on the CapEx. Is it possible to quantify what sort of investments we are looking for the pellet slurry pipeline? And also, since we are reaching to our deleveraging and leverage target, what over the next 2-3 years are we looking in terms of further forward integrating into finished steel at Jindal?
Yes, you're right. Each company, when it has a comfortable situation, they would definitely like to do plowing back the funds. There is no doubt into it. So first of all, we have to understand what our aim is. Our aim is 15, 15, 50. That is our aim. Now, meeting out this aim, if we are left with some surplus, then we'll keep on investing in the projects. And why projects and which projects? That is a big question. The projects which can definitely bring down our costs and which can make us the lowest cost producer of steel in the world will continue to be in our agenda. So this is the slurry pipeline and the pellet plant is part of that. There are two reasons. One, the environment-friendly transportation. As you know, that slurry pipelines are buried under the ground. There is no open trucks or open trains or goods trains or carrying the iron ore fines, transporting all the way to 600 kilometers or 800 kilometers, and then bring to the plant and then again loading, unloading. It creates a lot of problem. So 3 to 4% is the wastage in terms of loss during transit and handling. And over and above, there is a loss of about additional 1,200 rupees to 1,300 rupees in terms of transportation. So we want to be environment friendly first. Number two, we want to a cost effective company. So this is one reason. The other reason, as I told you, pellets, when we produce, we have our own DRI plant which consumes pellets and also blast furnace. So we want to feed our blast furnace and pellet plants with the best of the pellets available in the world so that the efficiencies can be improvised. And once the efficiencies are improvised, then we'll get at least 500 to 700 rupees per ton lower steel cost. This is the reason that we are looking in this. Now, as far as the investments are concerned, we are going with a humble beginning. One, we will not compromise on our 15,000 crores EBITDA level. One. Number two, over and above, whenever we get the chance, we'll keep on spending some money, maybe some 50, 70 crore, 100 crore rupees on month basis. Finally, say about maximum 1,000 or 1,200 crores. This is what in the annual now. There are no more extension plans as of now.
Understood. The second question is on the volumes. This year we are placed to achieve our guidance of 7.5, and next year you have shared earlier about 8.5 million tons. So for this year, what will be the mix in terms of semis, plates and finished long, and how do you see this mix, say in percentage terms, changing in FY22?
You see, it is a very on-spot decision. Sometimes it is a strategic planning. And, overall plans are like, for example, we had a 7.5 million ton of overall plan. And in overall plan, we thought that, okay, this much will be finished production. This will be category A, category B, category C products. But, all of a sudden, you have to have navigational changes in life. So all of a sudden, we stuck with the COVID lockdown situation on 22nd of March when government declared that there will lockdown. So we were in a big fix. What to do? The problem was how to survive. So how to run the plant, how to keep a lack of people, those who are working directly, indirectly alive. So that was a navigational change. I mean, it's like a flight which hits to the high clouds, then the route has to be changed. So is the planning. So we changed the plan from domestic market to the export market. And in export market, we again changed the plan that instead of looking for the rail buyers, looking for the plate buyers, looking for the hot rolled coil buyers, whosoever comes in line, we should supply to them. And we started selling semis, we started selling pig iron, we started selling plates, hot rolled coil and everything. So the product mix, it is very difficult today to decide, but yes, over a period of situation, whenever some situation comes, we'll address the situation accordingly and we'll change our product mix as and when required. The other second factor is that which product mix gives us the best EBITDA. Like you see, the rails are the high valued item, the shipbuilding plates are high valued items. Similarly, the plates required for defense applications are very high valued items. The situation is changed because of the government spending. So whenever we feel that government is spending in these particular projects, government is keen to spend on these products, then definitely we'll change our product mix accordingly. Like for the Power Grid Corporation of India, tomorrow they go for 1200 kV lines or 750 kV lines as against 440 or 230 kV lines. Then immediately the strategy will change. We'll go for the heavy angle irons to meet out the demand of the country. So finally, the project is the product lines are different. The value addition is different. So this is how I told in my opening remark that we are finding a right balance in between value engineering and value addition. So our aim is to bring to an equator that yes, the value engineering and value addition, they go line in line, side by side, over and above each other. So this is what we are planning.
Okay, thank you, sir. I have a few more questions. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Yeah, thanks for taking my questions and congratulations for a very good set of numbers that was significantly ahead of consensus. I have a couple of questions. The first one is on power business. I'm actually quite surprised by the circumspect tone you have. If you adjust for provisions, then in last 2 quarters, we are actually doing an EBITDA of 500 to 550 crores on average. And our realization has also picked up. Generation has also picked up. Add to the fact that we have now got our captive coal mine also. So how do you see this business going ahead? I typically would believe that, things should get better here on, but quite surprised by the circumspect tone. So can you let us know what would be the sustainable EBITDA per quarter going forward that we can look at? In the past, it has been around 300 to 350. But in last 2 quarters, I have seen, despite all the challenges you have mentioned, it is closer to 500 to 550. That is the first question.
Yeah, see, you rightly said that standalone there's nothing wrong with the company. But the question is, how do we control the macro factors which are impacting us? The macro factors which are impacting all the GenCos, not only JPL. We do not have control over the state response. Like Tanjatco, it is now everyone knows what's the scenario like. So though we are making we are generating EBITDA, we have generated EBITDA of average of about 300 to 350 crores on quarter-on-quarter basis in the current financial year. There has been some demand also, but the question is that going forward, if the overall demand, what is the per capita electricity consumption in India, and which is almost going very, very marginally is going up for the last so many years now. So the macro factors are something which are really bothering us. And there were certain items on the balance sheet which the auditors wanted us to look at it seriously. And since there has been a consistent performance now, not much of an improvement, if you look at the EBITDA, it has been more or less constant. So we decided that we need to provide for those liabilities which have now crystallized. And where we do not have any option, but if we need to clean the balance sheet, we have to provide for. So that's why, like I've been said in my earlier commentary, that a conscious decision was taken for providing for these long outstanding items. It was basically, I will give you the component also, it was a late payment surcharge, which the concerned agencies refused to pay. We cannot go to a court of law because they are our regular customers. So we decided to provide for that. Then there are change in law because of that, certain amount was there which they told in no uncertain terms that it will be very difficult for us to pay you. So these things were recognized and a conscious decision was taken to provide for. So I'm not saying that going forward there is a very bleak kind of a scenario. I say that is a modest kind of scenario. Thank you.
Okay. My second question is on, Jindal scheduled transaction again. So there is a set of related party transactions that Jindal scheduled has made with the promoter group that would be settled for USD 226 million. So is it possible to throw some light on these related party transactions? Which is the counterparty involved in all?
Basically, is a loan, is a total consideration deal done, $250 million. It has 2 parts. And this, I just request Nishant to address this. Yeah, Nishant.
Hi, thanks for the question. So as you know, the equity portion was $251 million, out of which $25 million was to come as cash, while the other 226 was to be assumed as liabilities by the buyer. Now, out of the $51 million, once the 49% has happened, around about $12.24 million has come home, while another 12.75 will flow in once the 51% gets done. Also, along with that, the $226 million worth of liabilities would be assumed by the buyer. Thank you.
No, Nishant, my question was precisely on that. Who is the counterparty to that 226 million?
The counterparty to that 226 million.
Somebody would give that cash.
No, Alex, so let me take a step back. So if you were to look in the original structure, right, JSPML, which is the Mauritius entity, owed $226 million, which had to be given to Oman. So that had to be returned to Oman by Mauritius. What has happened is that the new buyer has actually assumed those liabilities and is going to return those $226 million to Oman. So that is the part of the equity consideration that was taken care of.
Okay, understood. Thank you. Thanks and all the best.
Thanks, sir.
Thank you. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Hello. Hello.
Please go ahead with your question.
Yes, we can hear you.
Yeah. Hi, sir. Sir, I just wanted to understand if I look at the JPL per unit EBITDA, so even after adding the one-offs, it came somewhere around 1.5 rupees, while the realization has gone down by 30%. So, which portion has contributed such a tremendous improvement in the overall performance?
I'm sorry. Please repeat your question. Sorry about that.
So if I add back the one-off in the EBITDA in JPL and calculate the EBITDA per unit, it came around, it's actually improving around 30% on a quarter-on-quarter basis, while the realization was down by the similar amount. So this 60% improvement on adjusted basis on the quarter-on-quarter basis, just wanted to understand, is it because of your why it is so? Because your coal cost would have gone up also as per your past guidance.
No, coal cost has not gone up. Coal cost per kilowatt has come down by just 10 paise. So it's a very modest decrease in the coal cost because of better availability of the coal cost. So that is not fair to say that the coal cost has gone up. EBITDA, of course, has gone up, but if you look at the proportion, that the million units which we have sold and the EBITDA which we have made, if you look at the proportion compared to what the EBITDA was in 2020, 1920, you will see that in that proportion, EBITDA is not going up because the sale is more on spot exchange, where the rate we are not getting. Just to keep our boilers up, we are, and because there is some better availability of coal, we are selling more on, because PPA, you know that PPA remains fixed at 810 megawatt for long now. There is absolutely no PPA. So what is the option for us? There is absolutely no option for us but to force ourselves to sell on the spot exchange when we are not getting the rate. So if we do that calculation, we will see that overall it is not going in the same proportion like the way our, the sales figure is going down. So that is why this position is there, what you are talking about. Thank you.
Sir, but it does not explain the 50% improvement in overall profitability still. So just wanted to understand why that profitability is up by 50%, while the additional, like you rightly said, would have come at a lower price.
Yes, they see, I like told you that profitability is up because the demand has gone up and we have sold more units. Because there is a demand on the spot exchange which was not there last year. It was not that the spot exchange itself was not active. So we have been selling this more on so overall if you look at the demand and our sales figure, it will look much better. But if you look at the overall yield, the yield is going down because we are selling more on the exchange now.
Understood, sir. Understood. Sir, my second question.
Yeah, sorry. Is it over or some more clarification?
No, sir. Understood. So my second question pertains to the steel price realization. So if you could just tell us that what is the total since June in your blended product portfolio price increase you have witnessed, and how much is it factored till 3Q?
Sorry, June? Can you repeat, please?
So if you could tell us that since June till today, what is the overall blended price increase you have seen in your product portfolio, and how much it is factored till 3Q?
No, we cannot speak on June because, April, May, June was a lockdown situation and the country was passing through a very bad time. There was no demand from the country. Even July and August, mid till that time, there was no demand in the country. There was hardly any demand, so we were all banking upon the exports. So the export prices, if you see then and exports price now, there's a delta of about $150 and maybe $200 when we compare export to export. That is apple to apple. But the Indian steel prices were stable or little, I would say, started moving up in the month of October, November, December, because the iron ore prices have gone up. The iron ore prices have gone up by 180% in India, and that has created the havoc worldwide. And so is the situation in the international scenario. From $110, $115, it reached to $168. So that impacted the entire steel industry globally. The another point was on in October first week, the scrap prices are $305. It reached to $515 in January 2021. So that impact was $200, more than $200. If you said that itself is about 14,000 to 15,000 rupees. So the moment the iron ore prices, scrap prices, pig and DRI prices, they started moving, the steel prices also started moving in line with the raw material cost.
Okay, sir. So just to repeat in other words, so your current NSR, it is what percentage is above than your 3Q average NSR? If you could.
It is now the current NSR is we say the average of Q3. The average of Q3 is 41,500 rupees approximately. And if you say the standalone December, yes, it will be about 46,000. January will remain almost same. We are booked order till 28th of February 2021. Our order book is full. We are exporting also. We are giving domestic supplies also. We are in line with the NMDC prices and OMC prices. If the prices go down, then definitely the price will go down for steel as well. If the NMDC price increases, then definitely steel prices will increase. If they are stable, will remain stable. Hope I answered you.
Okay, sir. Okay. Thank you for answering my question.
Thank you. The next question is from the line of Ashish Kejriwal from DAM Capital. Please go ahead.
Yeah, thanks for the opportunity. Two questions, sir. One, you mentioned about coking coal inventory, which we have already for May. So, is it safe to assume that we have taken it at roughly around $105 only?
Yes, your question is correct because we did a lot of spot buying during this time when the prices were in two digits, $90, $92, $95, $99. And we also did some deals at $107, $110. Now the price is $130. The total pipeline we take, it is about up to May. We are fully covered. And as I told you, we are going to start our operations in Australia and we are going to ramp up Mozambique and South Africa, our own mines. So we'll be self-reliant, barring some about 25-30%. We'll keep on buying from different grades of coals from the other sources. But finally, we'll be swapping the overall business so that our cost of steel manufacturing and overall input costs are kept in control. And this is what the company is aiming to.
Okay. And so secondly, what we are hearing in the secondary market that long product prices or TMT bar prices have started falling, and it has fallen by 4,000 to 5,000 last 1 week. Though our product portfolio also consists of rails and others, which is somewhat sticky in nature, but at least in TMT, which we have around 25% of our portfolio, are we seeing any sense of price declining? And if it is there, how much it could be?
You see, as I told you, these are the navigational decisions what any industry has to take. So the point is not why the secondary market prices are going down. We have to find out the reason. The reason is today the scrap prices internationally have corrected by $50. So this $50 impact is a huge impact, and that is creating the price reduction. But the iron ore prices not gone down. DRI prices have not gone down. Coking coal prices, on the other hand, have started increasing. So there's two different theories today working in the country. So yes, you are right. There is a softening of prices in ingots, in TMT, and some other products, long products. But as you have already mentioned, that we are not in the product which are competing with either with the secondary producers or even with our peer group. So we are producing, we are the only company today in the country making 550 grade of TNT rebars. No other mills produces this commercially. We produce only, and this is one reason. The other is we have a great mix of products, like as I told you, rail structures, fabricated structures. We have plates, specialty plates, hot rolled coils. We are the widest hot rolled coil in the country, and perhaps we are the second or third widest hot rolled coil producer in the world. That is 3,000 millimeter wide. So overall, we are expecting a good time. And yes, if there are some corrections to be taken by us, we'll take the corrective measures as and when required. So these are the navigational decisions what we'll take in times to come.
So when you are talking about that till February our order book is full, so how much percentage mix, or you can say out of total volume, how much is already booked for this? Is it 60-65% or more than that?
This is a secret business plan. We normally don't disclose, but to give you a very broader idea, we are now banking upon the export orders from Saudi Arabia, from the Middle East, like Qatar, Oman, Bahrain, Kuwait, and UAE, and also for the hot rolled coil orders from Italy, France, Spain, Switzerland, and Germany. And these are the market pullers. So we have booked ourselves till end of February, and hopefully in next few days time we'll book for March also. So our Q4 will be healthy again.
So is it fair to assume that our blended realization in Q4 should be at least 5,000 rupees higher than Q3, assuming we have already booked till February and we are not seeing any major decline in prices?
You see, this is very difficult to predict all these things, 5,000, 4,000, because since morning we also read in many of the newspapers such kind of predictions. But very difficult as a responsible company in the country. We cannot say that today 5,000 rupees prices will go up or go down, because that impacts the entire nation. So as I told you, these are the navigational decisions. If we hit with bad weather, yes, we will take a longer route. If we are hit with a fine weather, tailwinds, then definitely we will reach to destination faster. So these are the decisions what we take. These are operational decisions, situational decisions. So, but I am not supporting the idea that 5,000 rupees will increase, or the 5,000 rupees per ton there will be increase in the EBITDA or something. No, I'm not supporting that. We are a responsible company. We have to be very responsible in giving the figures and data.
Thank you. Ladies and gentlemen, due to time constraint, we will take that as a last question. I now hand the conference over to Mr. Satish Kumar for closing comments.
Hi, on the behalf of InCred Capital, I thank you all for participating in this call. I thank the management and Nishant for giving us this opportunity for hosting this call. Over to you, Nishant, for any closing comments you want to make.
Thank you, Satish. Thank you, InCred, for organizing this call. I would request MD sir for any final comments. Sir.
Thank you, friends, ladies and gentlemen. It was a wonderful time with all of you. We have seen topsy-turvy behavior of the market during last 9-10 months time. We remember the situation in March, and now we remember the situation in January. We are thankful to Government of India. We are thankful to Honorable Prime Minister, who has brought in the COVID vaccine on time, I would say, and the results are phenomenal. Lakhs of people have been vaccinated in last 1 week time, and apart from vaccination, Indians Government of India has also sent its aid to joining countries like Bangladesh, Nepal, Bhutan, Sri Lanka, Maldives. I'm sure the people, those who are traveling to those countries and people, those who are coming to our countries, they will be in a position to do much more business, which was limiting during the COVID time. We are also thankful to Honorable Prime Minister for driving his campaign of Atmanirbhar Bharat, and that has definitely given the dividend to steel industry and as the industry as a whole. So economy is moving up. We have seen that GST collection is more than 1,15,000 crore. The last declaration by Government of India, that means more and more funds will flow to the state governments. The area of concern, yes, of course, today morning we read a news, 63,000 crore is to be recovered by Maharashtra State Electricity Board from Maharashtra. And these are the ripples, what my colleague Mr. Sinha was telling, that these are the uncertain behavior. That's why, and one of the question, he also told that why we are moving from PPAs to the exchange, because exchange, your money is not stuck up, though you may get a little less yield, but your liquidity is well maintained. And these are the situational decisions what company takes time to time. And I repeat again, the 15-15-50 is a target, not too ambitious. It is achievable. We are already 12,000 crore turnover. We are done in the quarter ending December 31st. So if we maintain same, we reach to 48,000 or 50,000 crore. You have seen the EBITDA levels reaching to 15,000 crore EBITDA is a very humble target. We can definitely achieve in support of everybody, and bringing down the debt burden or the loans to less than 15,000 crore is our ambition, and it is achievable. You have seen in 1 year time, we reduced 9 months time, we are reduced by 10,000 crores. And with the kind of EBITDA level, we are going to maintain the kind of lowest cost producer campaign that we want to be lowest cost producer in the world. This is the reason we are looking for the slurry pipeline, the pellet plants, so that we can be rated as a lowest cost producer in the world. And this is what we are aiming for. I'm sure the street will not disappoint ourselves and yourselves. State will definitely take it very positively in times to come. And we want to bring, Naveen ji always tells that I want that the JSPL should be the highest wealth creator in world, not only in steel, but across all commodities and products. I'm sure with your support, we'll reach to that level one day very soon. Thank you so much.
Thank you everybody for joining.
Thank you.
Thank you.
Ladies and gentlemen, on behalf of InCred Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.